Is Bitcoin truly the future of money, a revolutionary force democratizing finance, or is it just digital fool's gold, maybe a speculative bubble waiting to pop? Welcome to the money debate. Now, before we dive in, please remember this is absolutely not financial advice. Our goal today is simply to help you navigate some really complex information. In this deep dive, we're aiming to extract important insights from, well, various perspectives on Bitcoin and other digital assets. We'll explore Bitcoin's fundamental nature, its evolving role as an investment, the inherent risks that come with decentralization, and also the rapidly shifting global regulatory landscape. And we'll be drawing on insights from financial firms, academic research, and key regulatory bodies. Okay, so let's really unpack this, starting with the name everyone knows, Bitcoin. Beyond all the headlines and the hype, what actually is it? And maybe more importantly, how does it even exist without a traditional bank or government backing it?
Right. Well, at its core, Bitcoin is a type of cryptocurrency. The crypto part comes from its use of cryptography principles. These are used to essentially mint virtual coins. These coins are typically exchanged on decentralized computer networks, so directly between people using virtual wallets. But the real innovation, I think, is the blockchain.
Blockchain, yeah, we hear that term a lot.
Exactly. Think of it like a public, continuously updated digital diary or ledger. Every single transaction gets recorded publicly on this distributed, tamper-proof ledger. And this ingenious structure completely eliminates the need for any central authority, like a bank, to validate things.
Okay.
Bitcoin itself was famously launched back in 2009 by this pseudonymous figure or group, Satoshi Nakamoto. Nobody knows who that really is.
So it's the shared digital ledger, but how do new Bitcoins actually come into existence, and what keeps the whole decentralized system running and, well, secure?
Yeah, good question. That's where mining comes in. You have thousands of computing devices or nodes all around the world constantly working to verify and process these transactions. Some of these node operators dedicate, frankly, huge amounts of electricity and computational power to solve extremely complex math puzzles. It's a process known as proof of work.
Proof of work, right.
Their goal is to verify the integrity of these transactions and add new blocks of information to the existing chain. And the first one to successfully solve the puzzle gets rewarded with newly minted Bitcoin.
Ah, so that's the incentive.
Precisely. A new transaction block is added roughly every 10 minutes. And a really key design feature is that Bitcoin's total supply is strictly capped.
At 21 million, right?
At 21 million coins, exactly. That scarcity is absolutely fundamental to its whole design and potentially its value proposition.
Okay, so given this unique digital origin and this hard cap on supply, what does this all mean for how we perceive Bitcoin's value? Does it actually function like traditional money, or is there a fundamental, maybe even precarious difference here?
That's an excellent and absolutely crucial distinction to make. On the surface, traditional fiat money, say, the US dollar or the Euro Bitcoin, doesn't have a physical form. It's just digital. But here's the maybe surprising truth about Bitcoin's value. It holds value only as long as enough people believe in it.
Belief.
Yeah, and are prepared to exchange regular money for it. If that belief falters, well, it essentially becomes worthless. This reliance on collective trust, it's a characteristic it shares with what's sometimes called fiduciary money.
Like old forms of money.
Exactly. We've seen historical examples, like cowrie shells or those enormous ray stones of Yap Island.
Yeah.
They once served as money standards, but their values eventually plummeted when trust eroded. But what's critically different from, say, the money in your bank account deposit money is that deposit money is a liability of the banking system. It's fully backed by a bank's assets, things like loans and liquidity reserves.
Okay.
Bitcoin, in contrast, has no such backing, none at all. It is fundamentally a shared experiment in trust, constantly teetering on that collective belief.
Okay, here's where the debate gets really interesting, I think. Is Bitcoin truly digital gold? A safe haven in tumultuous times? Or is it, as some critics suggest, just pure speculation?
Well, there's certainly some compelling parallels to gold. You can see why people make the comparison.
Yeah.
Both are supply constrained, meaning their quantity is limited, and their demand isn't directly exposed to the usual ups and downs of economic cycles, not in the same way stocks might be.
Right.
Even the way investors can access them has sort of converged. You have exchange-traded funds, ETFs, which have successfully broadened adoption for both gold and now Bitcoin.
True, the Bitcoin ETFs were a big deal.
Huge. However, the fundamental differences are really significant. Gold is, well, it's a natural asset. It has thousands of years of reputation as a safe haven and a store of value. It's even seeing something of a renaissance now as a central bank reserve asset. Central banks are buying gold. Bitcoin, on the other hand, it's a technical asset. It emerged, remember, at a time when trust in traditional finance was pretty low, after the 2008 crisis. But in its comparatively short history, it has shown really excessive volatility, wild price swings.
So, if that volatility is such a challenge, what does that actually mean for someone thinking about it as an investment? Does it truly have a place in, say, a diversified portfolio?
That's the million-dollar question, isn't it?
Yep.
Or maybe the 21 million Bitcoin question. Look, Bitcoin's price volatility seems primarily driven by anticipated future adoption and, frankly, shifting sentiment, rather than its current utility as a widespread medium of exchange. Very few people are buying coffee with Bitcoin day to day.
Right. It's mostly held as an asset.
Exactly. And this introduces a significant level of risk. In fact, some sources we looked at indicate that major financial firms don't consider Bitcoin suitable for certain institutional investors. Things like UK pension schemes, charities, or endowments. They cite the substantial risks it poses to funding levels and long-term financial planning.
That's quite a warning for big institutions.
It is. And there's also something called superseding risk.
Superseding risk?
Yeah, the possibility that a newer, maybe superior digital store of value or even an alternative digital currency could emerge.
Right.
Something better might come along. And that could potentially render Bitcoin, well, close to worthless. It's a very real concern in such a rapidly innovating tech space.
But hold on, what about the argument that, well, all investments carry risk, or that the term speculation itself is sometimes misused? Aren't there some who would say Bitcoin is just, evolving?
That's a fair point, and it really touches on a core debate in this whole space. Some argue that maybe volatile is a more accurate term for Bitcoin than speculative. They'd note that almost any innovative asset in its early stages is going to experience significant price swings. Look at early tech stocks.
Okay.
And, it's also true that even sovereign fiat currency, like the dollar or the pound, is, let's be honest, virtually guaranteed to go down in value over time.
Yeah.
That's based on historical record and the stated policy of most central banks aiming for a small amount of inflation each year.
That's a provocative way to put it.
It is, but it's a perspective. Both Bitcoin and gold can indeed be seen as potential anti-dollars, maybe hedging against a reduction in reliance on the US dollar globally. In theory, they should serve as hedges against systemic financial risks.
But do they actually behave that way in practice?
Well, that's the crucial distinction in performance we've seen so far. Bitcoin often behaves more like a risk-on asset, meaning it tends to suffer significantly when general risk aversion spreads through financial markets. When investors get scared, they often sell Bitcoin along with stocks. This offers reduced diversification benefits when you might need them most.
Whereas gold.
Gold, in contrast, typically maintains its value, or sometimes even increases, during those risk-off periods. It acts more like traditional insurance. So while both assets should, in theory, excel as hedges during periods of systemic stress, like a major financial crisis, or serious doubts about a domestic currency's stability, that's really where Bitcoin only starts to approximate that idea of digital gold. Its track record isn't quite there yet.
Okay. We've explored Bitcoin's digital nature and its investment profile, including those unique risks. Now, let's maybe turn to the broader practical downsides, particularly the challenges that come with a system specifically designed without a central authority. What are the real-world implications of that decentralized design?
Yeah, this is critical. One of the most significant points is precisely that absence of a central regulator or intermediary. This means there's basically no authority to step in if transactions go wrong.
Like sending money to the wrong person.
Exactly. In traditional banking, if you accidentally transfer money to the wrong account, or maybe you fall victim to a scam, your bank can often help resolve these errors. Sometimes they can even provide compensation if your account gets hacked. In the blockchain world, generally speaking, if a payment is sent incorrectly or if your wallet is emptied by a hacker, users often have no recourse whatsoever. The transaction is usually final and irreversible. Code is law, as they sometimes say.
Wow. That sounds like a really heavy burden on the individual user. You're completely on your own. But what about just managing your own access? Is that something users need to be really acutely aware of?
Absolutely. Another very serious vulnerability is the potential for permanent loss of access. If you lose your Bitcoin wallet password, or more accurately, your private key, it's truly like losing a winning lottery ticket. Maybe worse, depending on how much you had.
And there's no forgot password link.
No,
Yeah.
none at all. Reports suggest that something like 20% of all Bitcoin might be permanently inaccessible due to lost passwords or people discarding old storage devices like hard drives. There are just countless stories out there about people who reformatted old hard drives or threw away old computers,
Mm.
only to realize years later that potentially millions of dollars worth of Bitcoin was lost forever.
Oh my goodness.
It really underscores an intense level of individual responsibility. There's no central bank, no help desk, no authority protecting Bitcoin users from simple human error or misfortune.
Okay, what about the integrity of the market itself? Are there concerns that come with such an maybe illiquid and decentralized structure?
Yes, significant concerns exist around market manipulation. You only need to look at the high-profile example of Elon Musk and Tesla's sort of on-again, off-again acceptance of Bitcoin.
Right, I remember that. Prices went wild.
They did. His public announcements, especially given that Tesla held large amounts of Bitcoin at the time, led to really strong price fluctuations. It highlights the relative illiquidity of the Bitcoin market, suggesting it could be quite easily influenced by large investors, what are sometimes called whales.
Whales, right.
In highly regulated mature markets, like stock markets, that kind of behavior would almost certainly be investigated by regulators as potential market manipulation.
And didn't Musk also raise concerns about the environmental impact?
He did. He specifically cited the significant energy consumption associated with Bitcoin mining, that proof-of-work process we discussed, as a reason for Tesla temporarily stopping Bitcoin payments. It highlights another practical downside that runs counter to, well, growing environmental concerns.
And beyond market behavior and energy use, there are those broader concerns about illicit activities, aren't there? The anonymity often associated with crypto has definitely raised red flags for authorities.
Indeed, organizations like the Financial Action Task Force, or FATF, it's the global anti-money laundering watchdog, they've identified significant concerns. They worry about the use of virtual assets for money laundering, terrorist financing, and also proliferation financing.
And how are countries doing at tackling that?
Well, while some jurisdictions have made progress, the global implementation of anti-money laundering, AML, and countering the financing of terrorism, CFT regulations for virtual assets, is still lagging quite a bit. As of recent reports, a staggering 75% of surveyed jurisdictions were only partially compliant or not compliant at all with FATF's requirements for virtual assets.
75%, that's huge.
It is. And specifically the travel rule, which requires financial institutions to share data on originator and beneficiary information for transactions above a certain threshold. Well, that hasn't been implemented by nearly 30% of jurisdictions yet. This poses ongoing challenges for financial integrity and the broader fight against illicit finance globally.
Okay, so we've definitely heard about the challenges and the risks. It paints a pretty cautionary picture in some ways. But beyond that, what's the larger, maybe more aspirational vision for this underlying technology? How might it actually improve our financial lives and the system in the future?
Right, and this is where the truly transformative potential lies, I think. And it really extends far beyond just Bitcoin itself. Blockchain technology more broadly has immense capacity to address issues like financial inclusion, access, and even financial education, especially for low-income households and underserved communities around the world.
Can you give an example?
Sure. Think back to the challenges in distributing the CARES Act stimulus payments in the U.S. during the pandemic. Many vulnerable populations really struggled to receive those funds quickly or efficiently. Now imagine a better financial system, perhaps built on some of these technologies, with proper privacy protections and maybe better data sharing between banks and government agencies. It could have potentially lessened that pain significantly.
Getting money to people faster.
Exactly. Ensuring funds reach those who need it the most, quickly and efficiently.
That sounds like a much more responsive, maybe even proactive financial system. You've also mentioned this concept of self-driving money before. Can you elaborate on that vision? What does that mean?
Yeah, self-driving or smart money is a truly fascinating vision of the future. Imagine a world where technology could automatically and intelligently manage your personal finances with minimal effort required from you.
Like autopilot for finance.
Kind of. Your retirement accounts, for instance, could potentially be rebalanced automatically based on market conditions, maybe aligned with your risk tolerance, without you ever needing to log in or make a trade. Credit cards could perhaps optimize automatically for your specific spending patterns or needs, rather than just maximizing fees for the issuers. You could have decentralized banking relationships, working cohesively across various accounts, checking, savings, investments, loans, to continually optimize towards your personal financial goals. This is all about leveraging things like AI, better data management, and crypto economics to make your money work harder and smarter for you, creating a much more seamless financial experience.
And the inclusion aspect.
Absolutely. It holds immense potential to democratize access for the unbanked, the underbanked, and underserved communities who currently face significant barriers getting into the traditional financial system.
You mentioned it goes beyond just cryptocurrencies, right?
Yeah.
The underlying blockchain technology itself has broader applications.
Exactly. The potential applications of blockchain technology extend far beyond just crypto. For example, it could greatly streamline and facilitate really complex processes like international trade finance, or managing supply chains, or even verifying identities securely,
So a whole new infrastructure.
potentially. It points to a new way of organizing finance and maybe many other industries too, where you can trust the underlying code and the decentralized ledger itself, creating new efficiencies and maybe even new levels of transparency.
That paints a picture of a potentially transformative future for money, one that could feel very different from our current system. But I suppose for any of this potential to reach its full scale, a robust global regulatory framework seems absolutely essential. How is the world adapting to regulate these rapidly evolving digital assets?
Yeah, that's the crucial piece of the puzzle right now. And what we're seeing isn't just new rules being written, it feels like a monumental shift is underway. Regulators globally seem to be finally moving beyond a sort of reactive regulation by enforcement approach, or even a Wild West approach.
Yeah.
They're seeking to actually legitimize digital assets within established frameworks.
Making it mainstream.
Essentially, the principle of same activity, same risk, same regulation is increasingly being applied even to complex areas like decentralized finance, DeFi platforms, and other crypto innovations. This isn't just about ensuring compliance. It's potentially about opening the floodgates for institutional money, for big players to get involved, and truly integrating crypto into the global financial system. It could change its very nature.
Okay, let's look at some key regions maybe leading this charge. How is the United States tackling this? It seemed quite fragmented before.
In the U.S., yeah, it has been fragmented. But 2025 looks like it might bring a shift towards a somewhat more crypto-friendly, or at least clearer, regulatory stance. Lawmakers are actively revisiting various crypto bills. A key goal is to clarify oversight, particularly resolving the long-standing question of the roles of the SEC versus the CFTC. Who regulates what? That clarity is vital for market participants.
Definitely.
And on the accounting side, which is also important, the Financial Accounting Standards Board, FASB, now mandates fair value measurement for crypto assets held by companies. This significantly improves transparency and actually makes it easier, from an accounting perspective, to hold digital assets on corporate balance sheets.
Trying to force it.
Enforcement actions have also increased, yes. They're extending anti-money laundering, AML, and Bank Secrecy Act, BSA requirements, to a broader range of virtual asset service providers, or VASPs, including, significantly, those operating in the DeFi space.
Okay, and what about Europe? They often seem to be ahead on comprehensive regulation.
They certainly made a big move with MiCAR, that's the Markets in Crypto Assets Regulation. It became fully operational in December 2024. This regulation is really seen as a cornerstone for the EU's single market for crypto assets. It provides much-needed legal certainty across the bloc.
What does it cover?
Well, it includes requirements for the authorization and ongoing supervision of crypto asset service providers, or CASPs. It mandates transparency and disclosure for those issuing crypto assets, mainly through detailed white papers. It also establishes a bespoke market abuse regime specifically for crypto and includes strong consumer protection measures.
Sounds comprehensive.
It is. It also addresses operational resilience through another piece of legislation called DORA and significantly strengthens AML and CFT compliance. Plus, the establishment of AMLA, the new EU anti-money laundering authority by 2025 or 2026, that's expected to centralize supervision and ensure these rules are applied consistently everywhere in the EU. It's considered a potential game changer globally.
And the United Kingdom, how are they positioning themselves amidst all these global developments, especially post-Brexit?
The UK is also actively developing its own comprehensive regulatory framework for crypto assets. They're moving deliberately. This framework includes compliance responsibilities across various areas: conduct of business, prudential requirements like capital reserves, safeguarding client assets, reporting requirements, and importantly, robust consumer protection.
And promoting crypto, how does that fit in?
Well, interestingly, financial promotions of qualifying crypto assets are now classified as restricted mass market investments. This comes with very strict rules. These include things like clear, prominent risk warnings, you might have seen them, and actually a ban on incentives to invest, like refer a friend bonuses for crypto. The aim is clearly to protect retail investors from undue influence or hype.
Right. So it sounds like there's a really concerted global effort underway to bring some order to this space. Are other major countries following suit or maybe even exploring their own digital currencies?
Absolutely. The Financial Action Task Force, FATF, continues its efforts to push for global implementation of those AML-CFT standards for virtual assets, recognizing that these are cross-border challenges by nature. And beyond that, yes, many other countries, places like Canada, Japan, Singapore, Switzerland, or Brazil, India, the UAE, many others are actively developing or updating their own regulatory frameworks for virtual assets. And a significant number, including major economies, are also actively exploring or even piloting central bank digital currencies, CBDCs.
CBDCs, right? That's a whole other topic.
It is, but it clearly shows this global movement towards integrating digital assets within mainstream financial systems rather than trying to isolate or ban them. The regulatory landscape is truly playing catch-up, and now it's trying to set the stage for whatever comes next.
Okay. So, bringing it all together, where does all this leave us on our big initial question? Is Bitcoin the future of money, or is it just digital fool's gold?
Well, based on everything we've explored today, I think you have to separate Bitcoin, the asset, from the underlying technology. Bitcoin itself, with its significant speculative volatility and that fundamental lack of central backing or intrinsic value in the traditional sense, it poses considerable risks as a conventional investment. It can be, as we said, quite a roller coaster,
Driven by belief.
driven largely by collective belief in future adoption rather than its present utility for payments. However, and this is the really critical distinction, that the underlying blockchain technology and the broader digital asset ecosystem that has sprung up around it, they hold immense promise. Real potential for truly transformative financial innovation, for greater inclusion, and perhaps for a more efficient, even self-driving financial future. So the distinction between Bitcoin as this single, very volatile asset and the potentially revolutionary technology it first unleashed, that's paramount, I think.
It definitely sounds like the story of money, particularly digital money, is really far from over. It feels much more like a journey, doesn't it? Not a destination. And it's clearly one that will continue to reshape our financial lives in pretty profound ways. What stands out to you then as maybe the most critical takeaway for our listeners from this deep dive?
If I had to pick one thing, it's probably that global push towards clearer, more consistent regulation. That seems to be the most critical factor right now in determining how these digital assets actually evolve and integrate into mainstream finance. Without that robust framework, the revolutionary potential we talked about remains constrained by uncertainty and significant risk. The future of money, digital or otherwise, really seems to hinge on finding that crucial balance between fostering innovation and ensuring stability and protection.
A balance, indeed. So here's a final thought for you to consider. As digital assets continue to evolve and integrate into our financial lives, how much of our future financial security will truly become self-driving? And what new challenges might that automation bring to our concepts of privacy and ultimately control over our own money? Thank you so much for joining us for this deep dive into the world of Bitcoin and the future of money. If you found this deep dive valuable, please be sure to subscribe to The Money Debate wherever you get your podcasts to stay well informed.